Hey everybody, this is Halstead and Andrew McMillan with REH CPA. Today we want to talk about getting classified as a real estate professional. For those of you that own rental properties, you're probably familiar with passive activity loss rules. And what those rules state is your passive activity losses that you incur from your rental property can only offset other passive activity income. Unless if you are at certain income thresholds, then you may be able to take some deductions. But we're talking about those higher income people that aren't able to take advantage of the $25,000 deduction for material participation. For those folks, they get wrapped up in these these passive activity loss rules. But we want to talk about an opportunity to get classified as a real estate professional to be able to currently deduct those real estate losses and to escape those passive activity loss rules. I've got Andrew McMillan here with me today. Andrew, what can you tell us about qualifying as a real estate professional?
So there's some specific rules to meet that the IRS is very clear about, and really the burden of proof is going to be on you as the taxpayer to be able to keep good logs of what you're doing, good time logs, so that you can make sure that you qualify, and if it's ever called into question, that you can justify it. But first, you have to make sure that more than 50% of the personal services that you do during the year is in real property, trades, or businesses. And then you also have to make sure that you spend more than 750 hours in real property,
and when
trades,
we talk
or
about
businesses.
real property, trades, or businesses, we're talking about realtor, construction contractors, things like that, right?
Exactly. So kind of a real life example for us, at least, is that person who works a W-2 job, earns a decent amount of money every year, but then has started investing in rental properties. And on paper, he's got some losses from those rental properties, and oftentimes they want to take those losses to offset this big W-2 wage that they have, but they can't because that loss is considered passive. They don't spend enough time in that activity to be qualified as a real estate professional. So the play is to try to spend more than 50% of your time in personal service, more than 50% of your time doing personal service work in real property, trades, or businesses, and meet the 750-hour requirement. And you have to materially participate in both of these. And I tell you, it's really hard for a W-2 wage employee to justify to the IRS that they are meeting these rules. If you're working 2,000 hours a year in a W-2 job, I mean, you're basically going to have to say that you spend another 2,000 hours working in a rental property and managing that property and doing everything that goes along with keeping that property running in order. And that's really hard to do. The IRS is aware of this. There's not a lot they haven't seen. Obviously, when it comes to these things, it's kind of hard to fool them. There's no aha, got you moments, really. So if you feel like you qualify for that, you definitely want to make sure you talk through it with a professional, because they should know the rules on this and the ins and outs and what they've seen. The only other really play here would be if you're married and you have a spouse that maybe works from home or doesn't have a full-time job. There is a play there where that person tries to spend the hours and materially participate in these rental properties. If they have any interest in being a real estate professional, that would be maybe I don't want to say safer play, but that's another angle to take at this of trying to get a spouse.
That's typically what we see. We'll see one spouse that's a high-income W-2, and they do some real estate investing, and the other spouse maybe doesn't work. They get a realtor license, and then they're able to manage those properties and meet those tests.
Right.
So
we have a lot of conversations. I mean, I have a lot of conversations with individuals who, like I said, maybe earn $200,000, $300,000, $400,000 a year on a W-2, have bought some rental properties, and say, well, I do all of the repair work. I do all of the phone calls. I write up. I'm talking with the tenants. That'll meet the
material participation piece, but not the real estate professional.
Right. That's a tough bar to get over, to be honest with you. So I wouldn't want to put a client in a bad spot there. So we always talk those through to make sure they fully understand these rules, and oftentimes.
And just to be clear, if you don't meet the real estate professional rules, you want to be able to deduct those currently, but if you don't, then it's not like you lose them. They do carry forward.
They do. So it's one of those kind of like happy now, sad later type things. If you deduct them now, that feels awesome, but then most people end up selling these rental properties
for a big gain
big gains, because now they've got this massive gain because they've taken all of these deductions through the years to offset other sources of income. They've already reaped the benefits of those deductions, and now you get hit with a big gain. So, taxes are very like shifting income. Like at the end of the day, you're going to pay taxes. In most situations, people are paying taxes. So, you can shift when you want to pay those taxes, but if you take those deductions now, it might offset your W-2 income at a higher tax rate, which is good. There's definitely some planning that can go along there, but just understand that now you don't have those losses to offset that big gain you have when you sell the property. Right. So it's not always bad to just kind of keep stacking up those losses and know that you have those when you go sell the property. Because you can use them then. So that's a good point.
Awesome. Really good information, Andrew. If you have any questions on being classified as a real estate professional in order to take your passive losses, feel free to give us a call and we'll help you out.